Today, ladies and gentlemen, we're diving down into the best Canadian dividend stocks with focus today on the financial sector and the real estate investment trust sector. We're going to rank the banks from the worst performers over the last 5 years to the best. We're going to take a look at the REITs that recently posted earnings to see how they're holding up in this higher interest rated environment. But before we do that, we got to roll back a little bit and just take a look at how the economy is performing, and we'll see the best performing sectors over the last month. Obviously, inflation is coming back down to a nominal rate as interest rates hit a 20-year high. I'm very anticipating that by next year, they're definitely going to start cutting these rates back. I know a lot of people don't think they are, but I'm pretty confident that they're going to, and it's going to lead to a good value setup for those of you buying kind of infrastructure, debted heavy companies, because unfortunately, when it comes to infrastructure companies like the telecommunication giants to even the likes of things like Enbridge, all of these things have been pulling back, the utilities, because they use a lot of debt to build up that infrastructure, and they're getting caught in the higher interest rated payments that have led to some bleeding in their stock prices. But I think because they're hitting record revenues thanks to the immigration that's been exploding here and the very limited companies the new immigrants have to sign up to when it comes to the telecom giants, the banks, the infrastructure companies, that's going to lead into some really good earnings into the future. But the TSX is only up about 4.84% year to date, always kind of underperforming the US markets, trading up 18% on the S&P 500. But we're buying this for income and stability, especially if you're a Canadian, you want that tax efficiency and you're utilizing that income. And taking a look at the sector performance so far this month, it's mostly been driven by the energy sector. I mean, you're seeing a lot of these energy stocks almost trade in the double digits, from Suncor. CNQ is doing very well here. But taking a look to the railways, not doing as bad. CNR, CP, those things are performing okay, nothing crazy there. The banks have relatively been flat, with TD being one of the best performers over the last month. Our technology sector still led by Constellation Software, Shopify getting hit pretty hard in the last month. And then there's a few outliers in like chemical and agriculture, but most of it's a pretty mixed bag, very similar to the US. Insurance is also very intriguing. There's been some good performance with Manulife. Some of the insurance payers also very interesting. Power Corporation, the company that owns Wealthsimple, doing pretty well this last month as well. But getting into it with VDY, I just want to opt into this really awesome monthly paying dividend ETF that I still follow pretty religiously. It's up 1.21% year to date, getting much more stabilization from the energy sector so far in the last month. And this one just gives you primary exposure to the financials and energy sector with a bit more diversification in some of these other sectors. But I think this gives you the best exposure to the best, largest Canadian companies, paying a 4.71% yield. You wipe off the 20% management fee, around 4.5%. Again, paid out monthly with a lot more stabilization over the last year, I've noticed, because coming into the last year, there was really high monthly payments, really low monthly payments, but it seems like everything has actually been leveling out. Primarily just in the last quarter. We'll see if that volatility changes over time, but over the last year, it's definitely been leveling off. If you take a look at the last 10 years, you can see there was a lot higher months and a lot lower months, and as of recent, things have gotten much better for those that want to actually utilize the income. But let's rank the banks first and foremost from the worst performers to the best performers over the last 5 years. I obviously own pretty much all of these banks, but at the bottom of the ranking over the last 5 years, BNS is down 15%. It's kind of crazy to think we've stepped that far back in time, but you always want to zoom out and take a look at the long term for those long-term focused investors. CM coming in at the second worst performer, down 7.93%, and over the long term, actually BNS has been a better performer because CM actually hasn't done much since the peak of the 2008 financial crisis. TD, I still think, is probably one of the better value players here, coming in at third, actually up 11.35% in the long-term chart, absolutely stellar. BMO, actually a big outlier here, it's up 15.1%, and the long-term chart, definitely one of the better performers. Surprisingly, the top two performers being Royal Bank, the largest company in Canada here, 5-year, up 24%, very stabilized performance as well. But one stock that I had to buy that just blows my mind consistently, that's hitting an all-time high out of all the other banks here, it's got to be National Bank, up 59% over the last 5 years, and has probably one of the most stable and up to the right charts of all the banks. Very intriguing stuff and very reasonable valuations in the current market environment. But switching over to the real estate investment trust sector, that's been getting just clobbered because of concerns in the real estate market. especially when it comes to interest rates. But I think there's really good value setups here. And Canadian Apartment Properties being pretty much the largest pure play to the rental market here in Canada, where rents have just been absolutely exploding. This company is benefiting from that greatly, along with the mass immigration, where there's just no more places to put people. And we're seeing that. And as mentioned, this was largely anticipated that these rents would start going up pretty dramatically, and they are. We're seeing basically the occupancy staying really high at about 98.8%. The average rent from 2020 has gone up dramatically. I mean, you look at June of 2020 and where it went from maybe around 1250 to 13 all the way up to 1450. This is going to go up way more and continue to go up as they have a turnover in tenants over time. Plus, their earnings not so bad. This company's kind of bunkering down. I don't think they're doing as many acquisitions or anything as crazy as they were, but the payout ratio is very stable at 61%. Their net operating income, most of everything has been improving because of obviously the turnover in tenants and the increase in rental prices. And they've been actually buying back shares. We can see their shares are down 3.8%. Very stabilized place to get income with. What's the current income on this one? Let's go into Yahoo here, because I think I'm pulling up maybe some of the US stocks on Google here, but 2.93%. If you can get a 3% yield on this, it's probably a very stable place to put some capital. But taking a look, we should talk about RioCan here as well. RioCan recently posted earnings with a 5.54% dividend. Has been trading down on the year, but has actually been performing pretty stably, in my opinion. It kind of peaked coming out of the pandemic and has been just generally flatlining to the downside ever since. But the earnings, nothing crazy. We're not talking about crazy upside here on the funds from operation. But again, they're also buying back shares. Their payout ratio is very favorable at I think around 50 to 60%. Net income was a little higher, probably from some sales of some properties. But this company has just been a steady eddy through this kind of current market environment. We're not talking about huge explosive growth. However, the one thing RioCan's been doing that's very intriguing is they've actually really done a good job at managing some of their debt. I noticed they've been paying it down, and their net asset value, so minusing their liabilities, gives them a book value, their NAV, of around $26 a share. So if REITs never trade in line with their stock prices, because the market can decide what they think the value is, but if you had to liquidate all the assets today, it is trading at quite a favorable discount, and I think most of the REITs are. Now we'll talk about another favorite REIT, and then I'm going to talk about what I think the best REIT is, in my opinion. But we're taking a look at SmartCentres here as well. With a 7.45% dividend yield, year to date is trending in the down direction as well. And these ones, they're all posting kind of similar numbers, things that aren't like, they're not super outreaching from a growth vector, but they're very stable nonetheless. And I think SmartCentres and RioCan give you great diversification across retail and storage and just a bunch of different property types. But taking a look here, you can see that their funds from operation did increase nicely year over year. You'd have to see if some of this comes from sales of properties or things of that nature. Payout ratio from adjusted funds from operations is at 93.8%. I'd probably trust this more than the payout ratio from cash flows, because there's going to be some write-downs, depreciation and amortization costs. You want to pay more attention to the funds from operations themselves versus the payout. But SmartCentres still coming in line here, nothing crazy. I don't think anything really stood out to me that is as devastating, and I'm really hoping that this kind of starts benefiting as interest rates come down and they start building massive condo buildings around their malls. They have crazy development pipelines, so there should be some stability in the dividend, and you'd probably look at getting most of your return from the dividend with these kind of REITs. But where I think there's some real growth vectors coming into play is things like Granite. You want to find these really sector-focused REITs, because I think I'm finding that the REITs with a core focus tend to have the better performance rather than the broad diversification. And I think this one's actually trading at a favorable discount here. Again, I don't know why Google only pulls up the US tickers for the Canadian REITs, but let's just take a look here, because this one's yielding around 4%. It looks like it's now dropping after earnings. I'd have to take a look into exactly why, but let's just dig into it, because when I pulled their earnings up here for the 3-month end here coming into June 30th, they have been growing. I mean, the revenues went up by what looks like 20 million, which is pretty incredible. Funds from operation jumped pretty nicely here, all in all. Even on the 6-month end, all their numbers have been pretty much improving. The payout ratio sits at 66% after adjustments, 73%. I've just been scrolling through and just taking a look at some of the numbers. Total debt, I think, sits at their debt to asset ratio. Their leverage is 32%. And this, again, mostly focused in logistics and shipping and warehousing. I'm going to dig a little farther into these things with like Dream Industrial, just to see what has been driving this kind of stellar performance. But I think these are still probably the better vectors for growth and income. You're not locking in a 7% yield, but you are getting some capital appreciation in REITs that actually look like they're able to benefit even in the higher interest rate environment from a growth standpoint. But I'm going to be taking a deeper look into things like Hydro One, Fortis, utilities, Manulife, Power Corporation. I'll probably do individual videos on some of these. Let me know what Canadian stock you'd like me to break down in depthly in that comment section below, and consider subscribing, because obviously I'm going to update my Canadian dividend stock portfolio as I do every week on this channel. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.